Tonight's Asia Open isn't normal. Silver isn't moving like a typical commodity anymore. It's moving like a stress signal. And the most dangerous part? The official market has already shown it can go dark at the exact moment traders need transparency the most. Just days ago, CME, the largest derivatives exchange on Earth, halted metals trading on Globex. Reuters reported the halt began at 12:15 p.m. Central Time, and metals didn't reopen until 1:45 p.m. And then came the detail that should make your stomach drop. CME said all-day orders and good till date orders for that day would be canceled. Think about what that means. In a fast market, that's not just a pause, that's a reset of the battlefield. And now we're walking straight into the Asia Open with Middle East headlines escalating, risk premiums snapping higher, and liquidity getting thinner by the minute. This is the exact environment where gaps don't fill, they expand, they go vertical. Because when fear hits and there aren't enough orders sitting in the book, price doesn't move smoothly, it jumps. So here's the question nobody wants to ask out loud. Why does the market reset right when volatility is highest? Why does the system that claims to deliver transparent price discovery keep stumbling, and always when the stakes are maximum? If you're watching silver tonight, you're not just watching a chart. You're watching a collision between paper pricing and physical reality. Off the screen can print any number. The real world can't print metal. In the next 25 minutes, I'm going to walk you through the hard data, the CME timeline, the COMEX inventory math, the China pricing signal, the lease rate stress and positioning from official reports. So by the end, you'll know exactly what this gap up really means and what to watch next. Now, let's lock down the timeline, because if you can't trust the clock, you can't trust the price. In Ham, we said it at the end of the hook, if you can't trust the clock, you can't trust the price. So before we talk about Iran headlines, Asia gap ups, or China pricing, we have to pin down the one thing that should be non-negotiable in any serious market, the timeline of what happened on the exchange that sets the benchmark. According to Reuters, CME Group halted trading on Globex for metals and natural gas due to a technical issue. The halt began at 12:15 p.m. Central Time, and natural gas was back first, reopening at 12:50 p.m. Central Time. But metals, including gold and silver futures, did not reopen until 1:45 p.m. Central Time. That's over an hour where price discovery for key precious metals was effectively paused inside the primary futures ecosystem. And again, Reuters reported CME said all-day orders and good till date orders would be canceled for the day, while good till cancel orders remained working. Now I want you to understand why this matters. Markets don't just move because of news. They move because of order flow, the bids and offers that form the book. When an exchange cancels entire categories of orders after a halt, it changes the shape of liquidity. It changes who gets filled, who gets stopped out, who gets to re-enter first, and how violently price can move when trading restarts. If you've never seen this in slow motion, picture it like this. You have a crowded highway, then suddenly the lights go out. And when the lights come back on, half the cars that were waiting at the intersection are gone. Even if nobody intended to cause a crash, the system has created the perfect conditions for chaos, because the flow that normally absorbs shocks is missing. This is also why the phrase technical issue is not a complete explanation. A technical issue can be real, but for analysts, the more important question is, what did the market look like immediately before and immediately after? On that, because the impact of the halt isn't just the pause, it's the restart. And this wasn't happening in a vacuum. Reuters noted that CME had also faced delays publishing metals settlement prices earlier in the month. Again, a settlement delay is not the same as a full trading halt, but it reinforces something critical. During a period of extreme volatility, the infrastructure that prints official numbers has shown repeated stress. That doesn't prove foul play, but it does justify skepticism, and it demands that we cross-check with data streams that don't rely on trust us. So let's line up the second layer of evidence. What did the price environment look like around this event? CME's own silver futures quotes showed the market trading in the mid-90s by late February into early March. That matters because when price is already elevated and volatility is rising, order books thin out. Spreads widen, the cost to hedge increases, and the market becomes hypersensitive to anything that interrupts the normal matching of buyers and sellers. Here's the simple mechanism that turns a normal market into a gap up goes vertical market. 1. Liquidity thins, especially around session transitions like the Asia Open. 2. Risk headlines hit. Geopolitical escalation is a classic catalyst. 3. Stops cluster above key levels because everyone sees the same chart zones. 4. A vacuum forms when the book can't absorb the flow. 5. Price jumps, not glides, because it has to search for the next pocket of liquidity. Now connect that back to the CME halt. If the exchange cancels day and GTD orders, the book composition changes. The restart is effectively a new auction with fewer resting orders than there otherwise would have been. That can increase slippage. It can magnify the first impulse move. And once you get that first impulse move, it feeds the narrative, it triggers more momentum flow. And suddenly you're watching what looks like a vertical launch. But again, we're not here to sell a story, we're here to build a case. So the way we test whether this is just noise or a real structural signal is by doing what professionals do. We look for confirmation in the physical and plumbing data, because a screen price can overshoot in both directions. What lasts is what the system can actually deliver. If paper markets behave strangely during a moment of stress, halts, cancellations, settlement delays, the next responsible step is not to panic. It's to measure inventory, delivery behavior, spreads, and regional pricing. That's where the argument gets real. So we've now locked down the timeline and the mechanics. We know the market halted. We know when it reopened. We know orders were canceled. We know the restart can reshape liquidity in a way that makes violent moves more likely, especially into a high-risk Asia Open. Now we move from the exchange narrative to the metal narrative, because paper can be printed, but physical has to be delivered. In part 3, I'm going to show you the numbers that matter most: COMEX inventory, the difference between registered and eligible, and why the China price narrative exists when the physical market tightens. We just proved something in part 2. When the exchange timeline gets messy, halts, delayed settlements, canceled order types, you do not respond with fear. You respond with verification, and the best verification is the part of the system that can't be talked into existence by an algorithm, the physical plumbing. So let's move from the exchange narrative to the metal narrative. The futures price is a paper reference, but underneath it sits a delivery system, vaults, inventories, and categories that determine whether metal is actually available to meet claims. And in silver, the most important split is this: registered versus eligible. Registered silver is metal that's approved and available for delivery against futures contracts. Eligible silver is metal stored in the vault system that meets specifications, but it's not necessarily committed for delivery. In other words, eligible is in the building, registered is on the loading dock. Now here's why this matters right into the Asia Open. LiveMint, citing official data, reported that registered silver on COMEX slipped below the critical 90 million ounce mark to 88,191,059.264 ounces, while eligible inventories declined to 278,065,980.223 ounces. And the same report states total COMEX silver inventories as of February 20th were 366.25 million ounces, down nearly 31% from about 532 million ounces in October 2025. That's not a minor dip. That's a system losing buffer. Now here's the paper versus physical stress test that changes everything. How large is the paper layer sitting on top of that deliverable pool? The CFTC's own other long report for COMEX silver lists. Silver Commodity Exchange Inc. Contracts of 5,000 troy ounces, with open interest at 125,454. Do the math. 125,454 contracts times 5,000 ounces equals 627,270,000 ounces of paper exposure, tied to a delivery mechanism where registered inventories were reported under 90 million ounces in that official snapshot. And no, this does not mean all open interest demands delivery. Most contracts are rolled, netted, or closed. But the point is structural. When registered is thin, the market becomes sensitive to even a small increase in delivery preference. It doesn't take everyone demanding metal. Often it takes a marginal shift, just enough players deciding, I don't want cash, I want bars. That's how paper markets get forced to respect physical constraints. Now let's connect this to the $120 China price, and why Asia matters so much. If you want a clean, verifiable China signal, look at SHFE settlement data. CEIC reports SHFE silver settlement, 4th month, at 22,126 renminbi per kilogram on February 27, 2026, and shows a recent peak of 29,487 renminbi per kilogram on January 30th, 2026. And SHFE itself notes the quotation unit is RMB yuan per kilogram for silver. Here's why those numbers matter. A regional physical market can express tightness earlier than a Western paper market, because local delivery conditions, local demand, and local constraints show up as a premium. And that premium can persist when arbitrage is slowed by logistics, restrictions, or simply lack of spare metal. When people say China is printing $120, they're not always making a precise FX conversion in real time. They're describing a real phenomenon. Regional price discovery can detach under stress. And the CEIC series, showing a January 30th peak in renminbi per kilogram, supports the idea that, at least during the late January blow-off, the China settled reference was consistent with triple-digit pricing pressure. Now step back and ask the bigger question. Why is physical tightness showing up at all? Reuters, citing the Silver Institute, reported the global silver market is expected to post a sixth consecutive annual deficit, estimated around 67 million ounces in 2026, while retail physical investment is forecast to rise. That's the backdrop that turns a headline shock, like Middle East escalation, into a vertical repricing event. In a market with plenty of slack, panic fades. In a market with a tightening physical buffer, panic prints gaps. So this is the physical reality, R simplified. COMEX registered inventories were reported below 90 million ounces in late February. Paper exposure via open interest was 125,454 contracts, a massive paper layer measured in hundreds of millions of ounces. China's settlement series shows violent spikes into late January, reinforcing the idea that Asia can express tightness early. And the structural deficit backdrop is not a rumor. It's in Reuters' reporting of Silver Institute forecasts. And now, here's the bridge. If inventory and regional pricing hint at physical stress, the next question is, how do we detect that stress in real time before the next vertical move? That's where macro signals come in. Lease rates, implied volatility, and other funding indicators that are harder to smooth over with narrative. In part 3, we established the physical backdrop. Registered inventory was reported under 90 million ounces in late February, while paper exposure measured in open interest was vastly larger. That's the foundation. But the market doesn't wait for proof to reprice. It reprices when stress shows up in the plumbing. So now we move to the signals that serious operators watch, because they're harder to fake with headlines or chart art. Lease rates, curve structure, backwardation/contango, implied volatility, and the swap/EFP bridge between London OTC and futures. OS1, lease rates, the price of access to metal. A lease rate is basically the market price of borrowing precious metal. When borrowing demand rises relative to lending supply, lease rates rise, just like any other price. LBMA explains it simply. If a market is undersupplied relative to demand, lease rates go up. If it's oversupplied, they stay low. That's why lease rates matter more than most retail indicators. They don't describe opinions. They describe availability. And we've already seen what an extreme spike looks like in this cycle. Bloomberg reported London silver lease rates fell to 5.6% after surging to a record 34.9% on October 9, 2025. Whether today's exact number is 2%, 6%, or 12% isn't the point. The point is the mechanism. When lease rates jump, someone is paying up for immediate metal access, often because the easiest inventory has already been spoken for. So as we head into a high-risk Asia Open, now here's what you watch. Are borrowing costs rising while price gaps higher? If yes, that's not just momentum. That can be scarcity being priced in. 2. Backwardation versus contango. The curve reveals urgency, next signal, the forward curve structure. LBMA's glossary defines it cleanly. Contango equals forward/futures, price above spot. Backwardation equals forward/futures price below spot. In normal precious metals conditions, contango is common because storage, financing, and time have a cost. Backwardation is rarer, and when it appears meaningfully, it can imply the market is willing to pay more for metal now than for metal later. This is not theoretical. Reuters reported in October 2025 that shortages of available silver in London drove spot prices above US COMEX futures, and that the dislocation made even airplane deliveries, normally reserved for higher value gold, profitable. That's what a real stress footprint looks like. Not a tweet, not a rumor, a curve inversion big enough to justify air freight. So into an Asia Open where the title is Gap Up Goes Vertical, here's the curve question. If you start seeing tight nearby spreads or spot premiums reemerge, that supports the idea that physical urgency is leading the move, not just paper chasing. 3. Implied volatility, CVOL, what the market is paying to insure itself. Now we stack the third signal, implied volatility. CME explicitly frames the silver CVOL index as a robust measure of 30-day implied volatility derived from options on silver futures. And CME's CVOL methodology document describes CVOL as a measure of the market's expectation of forward risk derived from actively traded options on futures, calculated each business day under its benchmark rules. Here's why CVOL matters in a squeeze-style environment. Price can rise and still be calm if the market expects stability. But when price rises and implied volatility rises, the market is telling you, this move is not stable, we're paying up for protection. That's how vertical gaps happen. The market doesn't just move higher, it moves higher while pricing a wider range of outcomes, which forces more hedging, more gamma effects, and more unstable liquidity. So into Asia Open, the question isn't only, is silver up? It's, is silver up while option implied risk is repricing higher? If yes, you're watching stress, not just trend. 4. Swap/EFP signals, where OTC and futures shake hands. Now the deeper one that most people miss, the swap/EFP bridge. LBMA notes that EFP, exchange for physical, allows traders to switch gold or silver futures positions to and from physical/unallocated accounts, and that is quoted as a dollar basis relative to current futures prices, making it a key component in pricing OTC spot gold/silver. TCME's own definitions describe EFP as a privately negotiated exchange of a futures position for a corresponding cash position, and EFR as a related exchange versus an OTC swap/other OTC instrument, both governed under CME Rule 538 structures. Why does this matter for our story? Because when the paper market is behaving strangely, halts, order cancellations, the OTC futures bridge becomes more important. If the basis, the EFP/spot spread, widens, it can reflect stress in the ability, or the willingness, to move risk and metal between London OTC and futures venues. CME even markets precious metals spot spreads as a tool to efficiently bridge futures and the London OTC market and transfer risk between markets. So if you want macro signals that don't care about narratives, this is one. Watch the basis and the bridge, because when that bridge shakes, price discovery becomes unstable. I'll bridge to part 5. So here's what we've built. Lease rates tell you the price of immediate metal access. Backwardation/premiums tell you the curve is screaming urgency now. CVOL tells you the market is paying up for forward risk. Swap/EFP/spot spreads tell you whether the OTC futures bridge is under strain. Now we ask the only question that matters. If these signals are flashing, how are the biggest players positioned? Because smart money doesn't post predictions, they file positions and structure hedges. In part 4, we nailed the macro signals. Funding stress, lease rates, curve urgency, backwardation, implied volatility, CVOL, and the OTC futures bridge, EFP. Now the next logical question is the one that matters most in a vertical market. Who is positioned for this, and who is forced to react? Because smart money doesn't show up in your feed with a prediction. Smart money shows up in reported positioning, in concentration, and in how risk gets reduced or rolled when a market enters stress mode. 1. Caught is the closest thing to receipts in this market. The commitment of traders report isn't perfect, it's weekly and it's aggregated, but it's still one of the cleanest windows we have into broad positioning, especially when the market is moving fast and narratives are flying. On the CFTC COMEX Silver Futures only report dated February 24th, 2026, the open interest sits at 125,454 contracts of 5,000 troy ounces. The breakdown shows non-commercial 32,500 long versus 10,240 short. Spreading 27,289. Commercial 35,475 long versus 76,555 short. Non-reportable 30,190 long versus 11,370 short. Let's translate that into plain English. Non-commercials, speculators, are net long. Commercials, hedgers/dealers/institutions with underlying exposure are net short, which is normal in many commodity markets. The key isn't commercials are short, the key is how the positioning changes as price gaps and funding stress rises. 2. The real tell, risk was being reduced and the market stayed unstable. Now look at the week-over-week changes, because that's where smart money behavior shows up. From the February 17th to February 24th change line, open interest fell by minus 6,042 contracts. Non-commercial longs fell minus 4,126, non-commercial shorts fell minus 2,383, spreading fell minus 2,338. Commercial longs fell minus 1,254, and commercial shorts fell minus 2,521. This is an underrated signal. In a clean bull stampede, you often see open interest rising as new money piles in. Here, open interest dropped while the market remained highly volatile, meaning a lot of activity was risk reduction, rolling, and repositioning, not just fresh FOMO buying. That's exactly what you'd expect in the window we're discussing. Asia open approaching, geopolitical shock risk rising, inventories tight, and implied volatility elevated. KT smart money doesn't need to be right today. It needs to survive today, so it reduces exposure, reshapes hedges, and keeps optionality. 3. Concentration. Why the short side can become a structural problem. Now we go one layer deeper, because in stress markets, what matters isn't only net positioning. It's how concentrated the risk is. The same CFTC report shows the percent of open interest held by the largest traders. For COMEX silver futures on February 24th, on 2026, 4 or fewer traders held 31.3% of gross shorts. 8 or fewer traders held 46.5% of gross shorts. That's not a conspiracy claim, that's a structural fact. The short side is relatively concentrated. And when the short side is concentrated, two things happen in a vertical move. 1. If price gaps higher into thin liquidity, shorts don't negotiate, they cover. 2. If physical tightness is real, the market can punish crowded exposure faster than participants can adjust. This is how a market goes from volatile to violent. It's not emotion, it's mechanics. 4. The second receipt stream. Warehouse products that publish metal count C-coat tells you the broad futures posture. But there's another place where institutional behavior leaves footprints. Large, metal-linked products that publish holdings and bar lists. For example, the iShares Silver Trust SLV publishes key facts including the ounces in trust and references its bar list/accounting basis. As of February 27, 2026, the iShares site shows ounces in trust 514,167,542.60. Tons in trust 15,992.40. It also provides a data download section and points users to documentation resources. Here's why this matters for smart money tracking. In squeeze-like periods, flows into major silver vehicles can become a real-world demand channel because creations/redemptions and inventory movements can translate into metal sourcing needs. It's not perfect, and it's not instant, but it is a published dataset you can monitor while the market is moving. 5. What smart money is actually doing in a market like this? If you combine everything we've built so far, physical tightness, macro stress signals, and concentrated positioning, the smart money playbook tends to look like this. Reduce directional fragility. Cut exposure when liquidity is thin. Keep optionality. Use options structures so you're not forced out by intraday spikes. Also, stay aware of the bridge EFP/OTC futures spreads, because that's where stress can show up before the headline crowd sees it. Watch positioning plus concentration, because those two decide how fast a move can cascade. And that brings us to the final piece of logic before the conclusion. If positioning is concentrated, inventories are thin, and volatility is repricing. Why is the trigger happening right into the Asia Open? That's where geopolitics and the industrial reality collide. Bridge. Part 6. Now let's zoom out and connect the trigger to the global picture. Because when geopolitics lights the fuse, silver doesn't just move on fear. It moves on the fact that the physical market was already tight. We just established in Part 5 that the market's posture is not calm conviction. It's positioning under pressure, open interest falling, exposure concentrated, and hedging becoming more expensive. So now we zoom out and answer the question that ties this entire video together. Why does this feel like an Asia Open shock moment instead of a normal Sunday night move? Because Asia Open is where the world reprices risk when the headline risk is global. And right now, the headline risk is a geopolitical escalation that instantly hits oil, inflation expectations, and safe haven behavior all at once. Reuters reporting describes a sharp escalation involving US-Israeli strikes on Iran, and a retaliation and immediate market anxiety across the region. Gulf equities down hard, Kuwait even suspending its stock exchange as a precaution, and growing concern about disruptions to oil shipping through the Strait of Hormuz. That same Reuters coverage also notes analysts raising crude forecasts toward $100 per barrel as a direct response to shipping and supply risk. And Reuters gathered analyst reactions describing the fear of a broader conflict, the likelihood of higher volatility, and the risk-off flow into traditional safe havens if the disruption persists. Now here's the key connection. Silver doesn't need to be a safe haven in the same way gold is to still explode higher in a shock. Silver sits at the crossroads of two powerful forces. One is monetary psychology, hard asset hedging when inflation risk jumps. The other is industrial reality, a metal with huge fabrication demand that can't just be swapped out overnight across every application. And so when oil risk spikes, the chain reaction is predictable. Oil up to inflation risk, up to real asset demand, up to volatility up. And when volatility rises into an Asia Open, when liquidity can be thinner and price discoveries more jumpy, you don't get smooth repricing. You get gaps, you get air pockets, and you get the kind of vertical behavior this title is pointing at. But the geopolitical spark is only the match. The firewood was already stacked. That firewood is the structural tightness we covered earlier. Thin deliverable buffers, persistent regional pricing signals, and a market that's been running deficits. Reuters, citing the Silver Institute, said 2026 is expected to be the sixth consecutive year of a structural deficit, estimated around 67 million ounces. And that same reporting adds important detail. Even with demand steady, the demand mix is shifting. Industrial fabrication is still massive, forecast around 650 million ounces, while retail physical investment demand is expected to rise materially. In other words, even if certain industrial categories soften or substitute at the margin, the base load of industrial demand remains enormous, and investment demand can surge quickly when confidence cracks. Now add the third piece, strategic policy and supply chain friction. Reuters reported on December 30th, 2025 that China listed 44 companies allowed to export silver for 2026 to 2027 under new measures. Whatever your interpretation, strategic tightening, administrative control, or just standard licensing, the practical implication is simple. If a major refining and manufacturing hub constrains the who can export funnel, it can introduce delays and frictions at the exact moment global demand is least patient. That's how regional premiums persist. That's how China price narratives are born. Not because one side is lying, but because different parts of the world are pricing different levels of immediacy and availability. And this is why the Asia Open matters so much in this story. Asia is not just another session. It's where a lot of physical demand, fabrication demand, and regional price discovery concentrates. So when a geopolitical shock hits over the weekend, Asia opens into it first with fresh liquidity, fresh risk limits, and fresh hedging flows. If the physical backdrop is already tight and the paper market is already sensitive, then the price doesn't test higher. It can reprice higher. Here's the clean way to frame it for the viewer. Geopolitics is the catalyst that changes urgency. Structural deficits are the reason urgency matters, and supply chain controls are what keep urgency from being arbitraged away quickly. So when you see gap up goes vertical, don't think of it as a mysterious event, and think of it as a system doing what systems do under stress, repricing to the level where someone is willing to sell liquidity and take the other side of panic. And now, we're ready for the last step before the conclusion. If this is the big picture, what's the single most useful thing a viewer can take away? It's a monitoring framework. Watch the headline, Risk into Asia Open, but verify with hard data. Inventory changes, spreads, lease/funding stress, and the positioning shifts that tell you whether the squeeze mechanics are still building or starting to release. Because if the system stabilizes, you'll see it in the plumbing first. And if the system is cracking, you'll see it in the plumbing first too, before the mainstream narrative catches up. And if you want the follow-up, because this story doesn't end tonight, subscribe to Finance Insider. In the next video, I'll show you a simple, real-time watch list, what to track daily, what signals actually lead, and what would prove this move is either a blow-off or the beginning of a much larger repricing.